first topic we're going to talk about today is just what is a fund exactly. We're going to dive in. I promised at the beginning when we set up this program that I wanted to teach you not only what it's like to be an angel investor, but a few steps past that. And so let's jump and dive into what a fund is and how they work and how they're managed. And then later we'll talk about how to do the inner part of that. So ultimately, like what makes a fund a fund? So there's lots of versions of fund. I pulled out the one definition that fits here. And so it's a sum of money. It's a collection of money for a particular purpose. It's a nice general version of fund. It has a little tighter version when we talk about venture capital funds and private equity funds and whatnot. But it is a pool of money. Right? It's a pool of capital. That's usually the jargon we use. And so pool, we're not talking about place you swim. A pool as in a common place, a common fund. Now we got a circular definition here. A common place where a bunch of different people, a bunch of contributors put in some financial capital in order to go do that thing that the fund is set up to do. And we're not talking about definition 4 there. So this is not a cartel. This is not it's not a trust. This is not something that we're doing to set prices or anything like that. It's just a structure where we can pool some capital together for a common purpose. That's the general idea. And the keywords in there are pool of capital. So we're collecting a bunch of capital, and the part about multiple people. So a fund by definition includes money from multiple people. And then every time we set one of these definitions in this world, we find out that there are in fact funds with one investor in them, or there are organizations that act just like this, but there's only money from one person. We'll just count those as if it were multiple people. They act the same way. And again, those multiple people are working together. And if you remember back from about, I don't know, 10 weeks ago or so, we talked about when multiple people are working together, well, there's a system for that. It's called a corporation or a partnership. In the fund world, the very first venture capital fund, and the reason I don't have a slide on this is between the time I wrote the slides, which was actually like 4 weeks ago, these are all new slides. Between the time I made the slides and now, I actually read a book on the history of venture capital. And so the very first venture capital fund was not in this structure, but the second one was, and the third one and almost all of them since. So in modern parlance, when we talk about a fund, a venture capital fund or private equity fund, it comes in this form of a partnership. So generally not a corporation model, but a partnership model. And we have legal ways to do that are limited liability partnerships as opposed to historical partnerships that didn't have that limited liability piece to it. And so in the fund management world, is a partnership, and there's two types of partners, two non-equal sets of partners. The general partner or general partners are the managers of the fund. It's their job to watch over that capital and figure out where to deploy it and do all the terms and conditions of putting it to work. That's the jargon we would use. And then harvesting the results, another piece of jargon in there, collecting the returns from the investments, right? Just being the managers of the company. Those are the general partners, and they're paid for that usually. And then the limited partners are the people who provided the capital. And the general partners could also have provided some capital, but the limited partners are not actively working in the fund. They don't have a day-to-day job trying to watch this money. They've handed the capital off to the general partners to do the work. And on the IRS forms, when you fill out the tax return for one of these funds, there's a checkbox for whether or not this owner was actively involved in the fund. And I have no idea what that does in terms of the taxes, but they ask it on every K1 form. There's a checkbox for that. Graphically, here's a pretty ugly picture of a fund. So the fund itself is a corporation, depending on how big it is. If it's big, it'll generally be structured as a limited liability partnership. And if it's smaller, it'll generally be incorporated as a limited liability company. There isn't a whole lot of difference between those two, but there's a distinction off in Delaware and other states. So I'll call out that distinction. And the limited partners are the owners of that fund, right? Or the partners of that fund. And then what's interesting here and not usually spoken about it's well known, but not spoken in those terms, is that generally the fund isn't actually run by the general partners, the people. The fund is usually run by another LLP or LLC, matching the structure of the fund. And that is actually the general partner. So the company that's the fund is run by, legally, another company. It's managed by another company, and that company is then owned by the general partners. And there's reasons for this structure, and my fund is set up just like this. So Fledge is an LLC, and I actually run a bunch of different little funds, and they're all LLCs. And then the general partner is a separate LLC, and that one's owned by me and one other group. The reason why they do this is that when you talk about a fund, it's usually underneath actually a series of funds. Each one started at a different date. So the general structure you hear about, if you're talking about the famous venture capital funds in California, like let's call it Sequoia Ventures, well, Sequoia isn't actually just one company. There is some company out there, probably called Sequoia General Partner, something like that, that is the general partner LLC. But then there's Sequoia 1, Sequoia 2, Sequoia 3, Sequoia 4, Sequoia 5, Sequoia 6. They're probably on 15 or 16 or 20 by now. Each one of those is a separate company. Each one has a lifetime. We'll talk about that in a bit. And all of them are run by one or more of these general partner companies. And so there's we think about one brand, but in fact, there are different funds that different investors can invest in. And what I'm trying to show here on the bottom here with these lines is that some of these investors could be in multiple funds, but not all of them. Not everybody transfers over from one fund to the other. Not all the funds have the same results. One of the funds at Sequoia owns Google, and owned Google, past tense, and none of the others did. So that one did much better than the rest of them. The next one might not have had any hits whatsoever. If we go back to that, 1 in 10 has to be a 10x. One of those funds may not have hit a 10x and not done well, but the other funds did. And so investors looked at the whole track record and bet on the next one. All right, so how do you set these things up? It's just a matter of legalese and legal work, right? So there's a whole bunch of regulations in this space. The regulations date back to the 1930s. The same acts that set up the Securities Exchange Commission, the SEC, they run how money can be raised into a fund. And then there's another law that was passed in 1940, and it defines what an investment company is and how they get registered or not registered, and all these exemptions around them. I've read through most of it. Together, it's hundreds and hundreds of pages of regulation. It's complicated. So you don't do it yourself. You hand it off to a lawyer to do. And the setup costs, vary depending on how big a fund you're setting up. It could be, if it's a very small little fund, and we'll talk about those, it could be hundreds of dollars. And if we're setting up a $1 billion venture capital fund, it could be maybe a few $100,000. And it could be anywhere in between. But tens of thousands of dollars to set up a fund is not unheard of. You got to worry about how you raise money. In the U.S., if you're raising money for either a company or a fund, you have to follow a bunch of rules. In fact, what you're doing is not following rules as much as looking for specific exemptions that have been written into the rules that let you raise money. By default, in the United States, it's illegal for a private company to raise money. That's an easy blanket statement to make. It's illegal for people to invest in a private company. And then the unless comes, unless that company is following specific exemptions laid out in the laws. And those exemptions historically have been only raise money from accredited investors or qualified investors, which is one level up from that. We usually don't talk about that. That's $5 million of net worth or more. Institutions that have $5 million of net worth or more are also qualified. And most of the half of the crowdfunding laws that got passed in 2012 don't apply to funds. So you can't go off and easily raise money from any American as a fund. You can as an operational company. All right, in terms of the operations of these funds, you got to pay the general partners, usually. You got to do accounting. If the fund is bigger than $10 million, you have to audit the financials. And that's tens of thousands of dollars per year right now. You, of course, have to file tax returns. Funds as partnerships don't pay taxes, but they do file tax returns. Then you need business licenses and all the normal stuff that an operating company has. And so to operate a fund costs between a few $100s if it's a tiny little special purpose vehicle, up through millions of dollars a year if it's a $1 billion fund with a 20-person staff. And the question is, when you sit down to say, I want to start a fund to go do this work, well, you got to write a business plan, and part of that business plan is figuring out how you pay for all that. We'll get to how you pay in the next slide. Most of the time, for historic reasons, venture capital funds and private equity funds and hedge funds typically are 10 years in length in time. So they take money at a certain period of time, very short window of opportunity to invest, and then they promise to liquidate all those assets and harvest all the results and get everything back to the LPs, back to the investors in 10 years. And what's the reality of this rule here and this norm, right? It's not a law, it's just a norm. The reality is that the unsuccessful funds meet that deadline and are all wrapped up in 10 years. And the somewhat successful funds, they might get extended by a year or two. And usually the norm is that the general partners have the right to just extend it by a year twice without asking any permission. And then usually in the documents, the investors collectively can extend the fund for as long as it needs to, right? Majority or supermajority a vote for that, not unanimous. And so the successful funds, the ones that are doing really well, will last for 15, 16, even 17 years. Because there'll be something in that fund that's doing really well, but hasn't been acquired, hasn't gone IPO, and nobody wants to do a fire sale. So you just keep extending the deadline, which means you have to pay for someone to keep watching over this, which eats into the profits. But the alternative is to find some buyer to fire sale to get rid of it, and that's a bad thing to do. Right? There really isn't secondary. There really aren't a whole lot of buyers for companies that look like they're about to go public but aren't public yet. There are some buyers out there, but not a whole lot. In a 10-year fund, again, the norm is that they spend 5 years looking for new investments. And so the first check to a new company has to go out in the first 5 years. And then more checks can go after that, because there's usually more than one round of funding in companies that go to venture capitalists. But they got to harvest the results in the last 5 years. And they have to be wrapped up in 10. And again, reality is more like 15. All right, the way you pay for this. So the norm out there is called 2 and 20. And it's been this way for a very long time, back so far that I can't even figure out who came up with this first. And I'm back in time to the 60s, not back in time to the 1600s. And so 2 and 20, and we'll talk about that as another jargon word. If you're out in the fund world, if someone's pitching you on a fund, you can ask them, are the fees 2 and 20? And if they don't know what you're talking about, that's a red flag. They don't know how a fund works. If you're raising a fund, you got to make it really clear whether you're 2 and 20 or something different, because this is exceedingly common. 95% of the funds use this structure. And so of course it has a meaning. The 2 in 2 and 20 means that every year, 2% of all the capital that's been promised to the fund is collected from the investors and spent on management fees. And so if it's a $100 million fund, that's the example here, then 2% of $100 million is $2 million. And it doesn't matter if the $100 million has been, in year one, when there's $100 million, or in day one, when there's $100 million in the bank in cash, the general partners will say, great, we need $2 million of that. Everybody chip in, ante up. We're going to take the first $2 million of this $100 million we just closed, and we're going to spend it on a really nice office and a nice staff and, free lunches, because we're VCs and we deserve it. And then after a year, when maybe 20 million of that 100 million has been put to work, they're going to take 2% again. And they're going to do this over and over and over again. And I'll talk about that in a bit as well. The 2 and 20, so the 20 in 2 and 20 is talking about the profits. So 20%, the term is carried interest, or just the carry, or carry, as we talk about it. And that means 20% of the profits go to the general partners. So again, if there's a $100 million fund and it returns a total of $250 million back to its investors, that's 2.5 times, which, as we saw weeks ago, is the goal. So what that really means in practice is that as the money's getting handed back, the first 100 million of returns goes back to the investors. And then once the 100 million is in the hands of the investors, the next 150 million is split 80 cents to the investors and 20 cents to the general partners. And so of that 150 million, 120 million would go to the limited partners, to the investors, and 30 million would go to the general partners. That's a $100 million fund. So you can see this is a pretty good business. Now it takes 10 years or 12 years or 15 years to get that money. So you might want to say, okay, we'll take 30 million and we'll divide it by 10, just because it's math's easier. And that's $3 million a year that's being handed to the general partners for their work. And on top of the $2 million they took in order to run the show. And this is why venture capitalists have this stereotype of being rich, because you can actually make money doing this. And I just want to point out that a $100 million fund is considered pretty small in the venture capital world. A normal venture capital, a traditional venture capital fund, would be more like 200, 300, 400, 500 million dollars. So we can multiply this by 3 or 4 or 5. It might be $100 million that's expected to go back to the general partners. And there are bigger funds than that. All right, but when we do the math on that 2%, here's where the crux comes, and here's where the trouble comes in trying to run a fund and trying to make money here. So if 2% of that $100 million is taken every year, 2% of anything is taken over 10 years, that's 20% of all the capital that's taken to run the fund. And when you do the math on what $250 million back is on 100 million in, the internal rate of return is about 20%. So there's an issue there. So again, if we had, $250 million is 2.5 times the $100 million. But if we spend $20 million of the 100 million running the show, then we can't put 20 million, you can't put the whole $100 million out into the companies. And so what we're saying is that same $250 million return has to be made on $80 million of investment. That's a 3.1x return. That's way higher than 2.5. That's much harder to do than 2.5. Does that make sense? Everyone, I can't see you.
Yes, that makes lots of sense. I got another question. Do you mind interruptions?
Please.
Okay, so we start with $100 million. And so on a 2%, you get $2 million up front, right?
Yeah.
At that point, let's say the fund grows, and it becomes worth $200 million. Then does the operation fee become 2% of $200 million, or does it stick on the $100 million, which was the original investment?
Great. Awesome question. In a venture capital fund or a private equity fund, typically what happens, and the keyword's on this slide here, typically what happens is that whenever there's something returned, there's an acquisition, whether it's a good acquisition or bad acquisition, like it was a 1x or half an X or 10x, every dollar that comes back to the fund gets turned around and distributed back to its investors that year. So there's usually, we would call this a one-time pass-through fund. It's usually that the money comes from investor to fund to company to investee. And then when it comes back from investee to fund, it goes straight back to the investors. And so there's never really an opportunity for that fund to truly double in value in terms of its managed capital. And so the 2% is on the committed capital or the promised capital to the fund, not on its current value in the bank account previous to distributions.
But then the question is on the other side of that. If you invest in 5 companies, one of them gets bought out 6 months after you invest in it, let's say, and then so the equivalent of $20 million. Let's say we start with $100 million.
Yeah.
20 million goes out to one of these companies. It comes back to the investors immediately. So at that point, is the management collecting 2% of 100 million or of 80 million?
It's basically if they close the fund at 100 million, they're going to take 2% of 100 million from then on. Whatever the closing value is, as opposed to the true assets under management. And then it gets slightly more complicated because in a full-scale $100 million or more, or even $20 million venture capital fund, the investors don't actually write a check for whatever they're investing. There's something called capital calls. Same thing happens in hedge funds. And so, let's just say the minimum investment was $1 million. Usually it's called over those 5 years when the investing's happening. So usually they'll say, okay, we want 20% of that right now. So we need a check from you for $200,000 upon close. And then once a year or so, we'll call the rest of the capital. We'll call another tranche of capital. So they might call 200 or 220 or 250 the next year. And then they might call 150 or 200,000 the next year. And they'll keep doing that until you've gotten to that whole million that you've promised, which gets tricky as an investor. Personally, I haven't done one of these, but I have friends that do. So they may have promised a whole bunch of money out to a whole bunch of different funds over the last 5 or 6 or 7 years. And they have to keep track of how much they've promised and how much do you think in cash these funds are going to ask for this year. And so you never know. And then if there is an acquisition early and you get some money back, that's good news in terms of being an investor, but then you got to shuffle and say, okay, now have I covered all my capital calls that are coming up, and do I have to go invest? Do I have to find something to invest in? Now the fix, it gets slightly more complicated again, because the fix to this 2% issue is that these days what funds are asking putting in their agreement is the right to recycle a little bit of the money. So they're asking for the right to recycle basically 20% of the capital so that the full 100 million can go get invested. And so it's not as simple anymore as a one-time pass-through. If there is an early acquisition, then the fund is going to say, okay, well, we're going to take that money and we're going to go put it to work because it's within the first 5 years. We're still investing and we want to make up for the difference of our fees.
So when they return when the investee, when the company that returns the capital to the fund, is that a taxable event for the investor if it's recycled?
Yes. The operating costs would just be the general, in the K1 parlance, the first box, that would just be operating expenses that get shared across all the investors. And then any return on capital would be either a capital loss or a return of capital or capital gain. And that would show up in box, what's that, 19 on the K1. So yeah, that's a taxable event. And then the rules, these are not simple agreements. You guys are all Fledge investors. I think that was a 20-page document. A VC LP agreement is going to be more like 50. And so there will be distributions. If there was a huge event and they recycled some capital, there'll be rules in there for doing a tax distribution to make sure that the highest tax rate can afford to pay the taxes on that money, even if some's recycled. So it may not be fully recycled. There may be some distribution that goes out in order to cover the taxes. It gets really complicated.
So Fledge, you recycle all the time, right?
No. So the original version of Fledge, we recycled until we had extra money lying around, which we never did. And then when Fledge got redone in 2017, we decided to switch to be a one-time pass-through fund. So except for our little lending fund that we're doing on the side, whenever any dollars come in from our investees, we put it in a special bank account that doesn't get touched until December, and then it gets distributed back to investors. So every December we empty that bank account, and if we ever have an extraordinary event in the middle of the year with a big exit, then we'll do a second distribution that year. So almost everybody's getting a check every year now. But we're not charging we're not charging a fee. We're a 0 in 20 fund. So we don't have this issue of not having our money put out to work.